We begin with Chapter 21. In this chapter, we will analyze in detail the long butterfly strategy. The long butterfly position is used when the market outlook is neutral around the strike price of the short options. The strategy consists of selling two options, buying one option with a lower strike price than the short options, and buying another option but with a higher strike price than the short options. All options must have the same expiration date. The options must be all calls or all puts, and the strike prices of the long options must be equidistant from the strike price of the short options. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contracts, and besides, the values do not include brokerage commissions. In the long butterfly strategy, the middle strike price, that is, the strike price of the short contracts, is called body. On the other hand, the lower and higher strike prices, that is, the strike prices of the long contracts, are called wings. Therefore, the debit paid to initiate the position is equal to the lower wing premium plus the higher wing premium minus the body premium multiplied by 2. That is, it is the difference between the premium paid and the premium received. The maximum profit on this strategy is limited. The most we can make is equal to the difference between the strike prices of the body and the lower wing minus the debit paid multiplied by the number of shares of a wing. On the other hand, the maximum loss that we are exposed to is also limited. The most we can lose is equal to the debit paid multiplied by the number of shares of a wing. As we said, in the long butterfly strategy, the middle strike price is called body, and the lower and higher strike prices are called wings. In general, the body is at the money, and therefore the wings are composed of an in-the-money option and an out-of-the-money option. This strategy has two break-even points, a break-even point to the downside, called break-even point 1, and a break-even point to the upside, called break-even point 2. Break-even point 1 is equal to the strike price of the lower wing plus the debit paid. On the other hand, break-even point 2 is equal to the strike price of the higher wing minus the debit paid. The break-even points define the profit and loss zones. In our case, for stock prices lower than break-even point 1 or higher than break-even point 2, we are in a losing situation. In contrast, for stock prices between break-even point 1 and break-even point 2, we are in a profitable situation. When the long butterfly is structured using calls, it can be thought of as the combination of a bull call spread and a bear call spread. In contrast, when it is structured using puts, it can be thought of as the combination of a bull put spread and a bear put spread. Continuing with the analysis, the initial margin required to open the position is equal to the 100% of the total debit paid. An increase in volatility typically hurts the position. Time decay typically helps the position. With respect to exit conditions, to close the position, we must buy the short options, that is, the body, and sell the long options, that is, the wings. If the stock price is higher than break-even point 1 and lower than break-even point 2, we are in a profitable situation. Otherwise, we are in a losing situation. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at trade initiation. As we get closer to options expiration, the curve of profits and losses is like the one shown in green. And finally, at options expiration, the curve of profits and losses is the one shown in red. For this strategy, time decay typically helps the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Coca-Cola Company. As we can see, during the months of April, May, and June 2011, the stock was trading in a range between $65 and $69. As we said, during the months of April, May, and June 2011, Coca-Cola was trading in a range between $65 and $69. If we expected that the stock would stay in that range for the next few months, at that time, we could have entered a long butterfly. At the close of June 30, 2011, Coca-Cola was trading at about $67.3, while the options expiring in August 2011 had a premium of $2.94 for the 65 strike calls, $1.23 for the 67.5 strike calls, and 31 cents for the 70 strike calls. Thus, we could have bought 10 calls with a strike price of $65 and expiration in August 2011 at $2.94, sold 20 calls with a strike price of $67.5 and same expiration at $1.23, and bought 10 calls with a strike price of $70 and same expiration at 31 cents. With the 10 long contracts per wing, we would be in control of 1,000 shares in each of them. So the long butterfly would have cost us 79 cents per share, that is, $790 overall. The maximum profit is given by the difference between the body and the lower wing, minus the debit paid, multiplied by the number of shares of a wing, in our case 67.5 minus 65 minus 0.79, multiplied by 1,000, which is equal to $1,710. During the month of July, the stock was trading between $66.5 and $70. Finally, on August 2, 2011, it closed at $67.07. In this example, the long butterfly was structured using calls because the risk graph of the strategy would have been the same whether we had used calls or puts. As we said, we initiated the trade on June 30, and during the next month, the stock was trading between $66.5 and $70. Finally, on August 2, it closed at $67.07. At that time, the options had a premium of $2.78 for the 65 strike calls, 81 cents for the 67.5 strike calls, and 15 cents for the 70 strike calls. If we had closed the position at that time by selling at 2.78, buying at 0.81, and selling at 0.15, we would have received a credit of $1.31, so our profit would have been 52 cents per share, because we had placed the trade at a debit of 79 cents per share. Thus, we would have had a total profit of $520, making a 66% return on investment in 33 days. That is, we made $520 by investing $790. So, we would have made the 30% of the maximum potential profit for this strategy, which was $1,710. After August 2, the stock was trading between $64 and $69.5. Finally, on expiration Friday, August 19, it closed at $67.1. That can be seen here. After August 2, the stock was trading between $64 and $69.5. Finally, on the expiration date of the options, it closed at $67.1. At that time, the calls with the strike price of 65 expired in the money, while the calls with the strike prices of 67.5 and 70 expired out of the money. So the 65 strike calls would be worth $2.1 per share. Therefore, if we had held the position to expiration, we would have received a credit of $2.1 per share, so our profit would have been $1.31 per share, because we had placed the trade at a debit of 79 cents per share. Thus, we would have had a total profit of $1,310, making a 166% return on investment in 50 days. That is, we made $1,310 by investing $790. So we would have made the 77% of the maximum potential profit for this strategy, which was $1,710. Here we can see the numbers of our example. The strategy consisted of buying 10 Coca-Cola calls with a strike price of $65 and expiration in August 2011 at $2.94, selling 20 calls with a strike price of $67.5 and same expiration at $1.23, and buying 10 calls with a strike price of $70 and same expiration at 31 cents. That is, we placed a 65, 67.5, 70 long call butterfly times 10. The debit paid is the difference between the premium paid and the premium received. In our case, 2.94 plus 0.31 minus 1.23 multiplied by 2, which is equal to 79 cents. Therefore, our investment is equal to 0.79 multiplied by 100, which is the cost of the strategy per contract, multiplied by 10, which is the number of long butterflies we entered. That's a total of $790. This money is debited from our account. The initial margin required is equal to the 100% of the total debit paid, that is, $790. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit we can make is equal to the difference between the strike prices of the body and the lower wing, minus the debit paid, multiplied by the number of shares of a wing. That is $1,710. If we had sold at 2.78, bought at 0.81, and sold at 0.15, we would have made a profit of $520. On the other hand, the maximum loss that we are exposed to is equal to $790. That is, the total debit paid. Regarding the break-even points, break-even point 1 is equal to the strike price of the lower wing plus the debit paid. In our case, 65 plus 0.79, which is equal to $65.79. On the other hand, break-even point 2 is equal to the strike price of the higher wing minus the debit paid. In our case, 70 minus 0.79, which is equal to $69.21. Here we can see the order we must enter to open the position. It is in order with 3 legs. Leg number 1 corresponds to the lower wing and consists of buying 10 Coca-Cola calls with a strike price of $65 and expiration in August 2011. Leg number 2 corresponds to the body and consists of selling 20 calls with a strike price of $67.5 and same expiration date. Leg number 3 corresponds to the higher wing and consists of buying 10 calls with a strike price of $70 and same expiration date. The entered price is given by the difference between the purchase and selling prices, that is, the premium paid minus the premium received. In this case, 2.94 plus 0.31 minus 1.23 multiplied by 2, which is equal to 79 cents. This is the money, expressed per share, that will be debited from our account when the order is filled. On the other hand, here is an example of the order we must enter to close the position. It is an order with 3 legs. Leg number 1 consists of selling the calls of the lower wing. Leg number 2 consists of buying the calls of the body. Leg number 3 consists of selling the calls of the higher wing. The entered price is given by the difference between the selling and purchase prices. In this case, 2.78 plus 0.15 minus 0.81 multiplied by 2, which is equal to $1.31. This is the money, expressed per share, that will be credited to our account when the order is filled. Here we ended with the chapter Long Butterfly. In the next chapter, number 22, we will analyze in detail the Long Condor strategy.